Hello, traders. Gary Wagner with the Gold Forecast. It is Tuesday, October the 26th, and this is the Daily Report. Gold currently trading at approximately 1338 to 1339. That's trading it off approximately $2 this morning. The real story, though, is that the way gold is trading down $2, and that is there is some significant strengthening of the US dollar, and that is causing gold as it's related or pegged against the US dollar to be down about $11. However, predominant buying is causing it to rise about $9. In other words, in countries or gold pitted against other currencies are actually accelerating quite well today. There is buying going on in the market, but that push-pull of the change of the US dollar as it compares to buying is putting it down about $2. On today's report, we're going to talk about what we're looking at through the rest of the week, where we think the market's going, and look at the potential that we saw for this bottom, and do we think that that will continue? All here on today's Daily Report. Traders, what I'm seeing in the market is even with this strengthening of the US dollar, which is causing gold to go down in relationship, of course, to the dollar, we do have some steady bargain hunting moving into the market. And the reason that that's so clear to me is absolutely the nature of these doji candles, especially something like this. And let me explain what I mean by that. In essence, what happens is as follows. If you have a basic market and what you're looking at is the market opens at a certain area, let's say right in here, and then what happens is as that market moves higher, it creates a red candle. As it moves lower, it creates a black candle. So the market moves up a little bit, and then what you see is the sellers take the market down. And at this point, this candle is actually a black candle. What happens is when you get bargain hunters coming into the market, you get these lows right in here, and that pushes price activity back up too near the close. What that tells you is that the point in which we saw the bargain hunters, of course, was that point in which we see this market at the bottom and moving back up. If there was no bargain hunting, if there was no buying in the market, you get a candle that is a black candle, such as right here. Here's where the market comes down but closes near the lows. Up here, the market comes down and closes near the lows. That's why when we look at the bottom activity for this three-river Morningstar variation, it's essential when we see the longer the tail, the more it lets us know that bargain hunting has come in and that it is the buying activity that has pushed the market back up. Now, of course, if the market ends up turning into a red candle, meaning that rather than just going to the close here, for example, what you get, let's say, is the market moving up, you will get a red candle, something like this, depending on where it closes, and that shows you that there's even more significant buying power because it takes it above the open of the day. Currently, as you can see right in here, we're trading at 139. It is still well off these lows, but it is trading at the open of the day. So we're going to have to see where it goes. But you absolutely have to understand the significance of this type of candle, your basic doji, because the powerful statement within it is the fact that you could see these lows, of course, and then the markets sell down. That's what creates these lows, but buying comes into the market and pushes it back up. That tells you that you have absolutely bargain hunting coming into the market because they are absolutely buying the dips. Now, where do I think this market is going? Well, we talked about this yesterday, but I just want to reiterate because I don't think that we've changed any of that. And that is, I am simply looking as wave one as our benchmark wave to tell us how big waves 3 and then wave 5, those are our three what's called our impulse waves before we get a correction. And let me kind of show you what I mean by that. let's go back to a full set of waves. Now, a full set of waves, of course, is going to be as follows. It's 1 through 5. So what happens is this is the fifth wave, 1221, back in December 2009. And from there, you get what's called your corrective phase. Corrective phase is always going to be waves A, B, and C. And that's what puts you to the bottom of the market. Your actual, what we call impulse phase, is going to be from the beginning of wave 1 all the way to wave 5, right in here. So what you do is you have a series of 5 waves. Of the 5 waves, you have 3 what's called impulse waves. Waves 1, wave 3, and wave 5. The impulse waves are always going in the direction of the predominant trend, and of course the predominant trend right here is up. Now, so you get 1, you get this first corrective wave 2, and then you get your second corrective wave 4. Now, the reason that I bring this all up to you is because what you want to realize is that we use this wave 1 right here as our benchmark for waves 3 and waves 5. And the way that we do this is just very, very simple. We take the amplitude, meaning the distance that we moved right here in wave 1, and we use that as our benchmark. So that what we're going to say is that wave 3 should equal roughly 1.61 times wave 1, and wave 5 should be about equal to wave 1. Now, on this last run here, we had a $100 move here. We had a $161 move here. It was exactly 1.61, and we had another $100 move here. So as you can see, at least in this one example, because it doesn't always hold true, in this one example, this was a textbook case in which these waves followed Elliott wave quite eloquently. So that being said, now we are looking at, of course, our new area. So we have, this is the beginning of our impulse phase here, and that's after waves 1, 2, 3, 4, 5. And what you will see is that if we take this move and we times it by 1.61, it was about $18 shy. That put us at about $1,400. So that rather than having a 1.61 move, we had about a 1.5 move. Very, very close. Now, the question is, now that we've entered this fifth wave, all I've done is done a basic projection, and what I've done with that projection is I have taken this line. This is actually a copy of this. It's a scalable line, and I've simply placed it to the bottom and extended it so that it shows us a very, very strong plausibility of where the market should go. And so right now I'm pegging it to go just at about, I would say 1414 to 1420 is what I'm looking at for the end of this impulse cycle and this impulse wave. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow. Bye-bye.